Hey guys, welcome to the last episode of Tools of the Trade. In this episode, we're going to be learning how to use indicators, both Inchart as well as oscillators. Technical indicators are a great tool to have for any trader. They make our lives so much easier. But there is such a thing as having too many indicators. When we look at them, we want to be able to see a summary of what's going on and to have the information given to us in a very concise and clear manner. When we look at something like this, chances are we're not going to be able to make an educated decision because there's just too much noise, there's too much going on. In today's video, I want to teach you guys about the different types of indicators, how are they different from each other, but also how do they work with each other. As traders, as technical traders, our goal should be to have a reduced small number of indicators working with each other that tell us very quickly, in literally 1 or 2 seconds, whether we should be interested in a chart or not. Okay, so first things first, what is a technical indicator and how is it calculated? Well, technical indicators are based on mathematical formulas which are based on price and volume, and they each have their own different formula. They each are calculated differently. But all of them, they look at the past price performance, how the price acted in the past, whether the past 5 minutes or the past 2 years. That's up to the trader. And they give you an estimation of what is it that you can expect the price to do next. Now I say estimation because it is impossible to predict the future. The price is going to do whatever it wants. But indicators can give you an idea of what to expect. Having said this, there are 2 types of indicators. There are Inchart indicators, which are, as their name suggests, fall inside the price chart. And then there are oscillators, which fall usually below the chart, but it's also possible to see them right above it. Let's take a look at Inchart indicators first. What do they do? They tell us how far is the price likely to go. And there are many types of indicators, but the 2 most basic ones are moving averages, which are great, and the different types of channels. In this video, we'll cover the envelope channel, but the Bollinger Bands, for instance, are another extremely popular indicator. For example, take a look at this chart of Ally, ALLY. If we don't throw any indicators in there, we see that the chart is trending up, but we don't really have anything to use as reference when we trade. Now take a look again at the same chart of Ally, ALLY, only this time we threw a moving average in there. As you can see, the price bounces off on that line, on the moving average, multiple times, and it's almost like this line has a magnetic effect on the price. Even though the price tries to get away from it, it always ends up coming back. Similarly, we could use 2 moving averages instead of 1 to create an area in between these 2 lines, in between these 2 prices, to create a price range, right? And in this case, the price would be bouncing off this area rather than just one specific line. It's a lot easier to catch the different swings when you use 2 moving averages versus just 1. Now taking a look at still the same Ally chart, ALLY, we now see that we have 2 lines above and below the moving averages. These are known as the envelope channel, and they're going to tell us how far the price is likely to go. How far is it likely to climb before it turns around and falls back to the moving averages? So the way these 2 indicators work together, the moving averages and the envelope channel or any other channel, is by first giving you an area that would be interesting to open a trade, and then giving you a range of how far each swing is likely to go. Next, we're going to be taking a look at oscillators. What these indicators measure is how much strength does the price have. And there's a number of them. There's the RSI, Relative Strength Index, which is super popular. The stochastics, Williams R, But in essence, they all work the same. So once you learn how to read one or how to use one, you're going to be comfortable with all of them. Okay guys, so let's go back to our chart, the same ally chart we have been using. If you look at this one, you will see that there is something in the bottom, right? That is an oscillator. That's an indicator that falls outside of the main price chart. And every oscillator has two areas of interest. There's the oversold area, and then there is the overbought area, and you can see them marked on this chart. What the oversold area is going to tell us is when has a price been sold too much, oversold. And when this happens, the selling strength is going to diminish. It has been overdone. It needs a correction. So by selling, you're going to push the price down. If you sell too much, you run out of strength, and thus if the price doesn't go down, if the price doesn't have the strength to go down, what's going to happen? It's going to come up. Similarly, the overbought area is the same, but the other way around. When a stock has been bought too much, it's running out of steam, it's running out of strength, and chances are it's going to turn around and go down. Okay, so that's great, but how do we use oscillators, in this case the RSI? Well, every time that the price falls to between the two moving averages in the main price chart, and the oscillator, again the RSI in this case, but you can use any oscillator, every time it falls to oversold, that's going to be an interesting point for us to begin our trades, to open our trades. If you can see on this chart, every time the price falls to that area between the two moving averages, as well as to the oversold area, it gets picked up and it goes right back up. Now, one more thing that I want to cover in this video is to suggest that you guys always trade with the main trend. Okay, there's one saying, the trend is your friend. You should always keep that in mind. Now, okay, that's great, but how do we find out where the trend is going? Well, the easiest way I know is to go to a higher time frame than the one you're using. Say that you're trading with the daily chart, you go up to the weekly, and then you use this indicator called MACD, moving average, convergence, divergence. What the MACD does is, like, it's an oscillator and it measures the strength of the price, but it also tells you exactly where the main trend is going, okay? I like to think of it as a traffic light. When I'm driving, if I see a red light, I need to stop. If I see a green light, I need to go. I can go, right? Same goes with my trading and the MACD. If the MACD is crossed against me, that's a no-go for whatever trade I'm looking at. If it's crossed my way, that's a green light. I am free to trade if everything else is aligned. Okay, great. So how do we use a MACD? How do we interpret it? Well, first, we are assuming that we're trading with a daily chart. We're gonna go to a weekly chart, and this is a weekly chart of Ally, same chart that we have been using this entire video, okay? And then we're gonna throw the MACD below, like you see. And then we're going to take a look at the indicator itself. We're gonna take a look at those two lines, and we're going to see which way they are crossed. If they're crossed upwards, like in this example, that's going to mean that the main trend is an uptrend, which will allow us to trade it in our trading time frame. So we would go down to the daily time frame if that's the one we use to trade, and then we would start to look for a good entry point. Alright guys, so in this video we covered Inchart Indicators, we covered oscillators, and we covered the basics of trend following. These elements combined will give you a very solid base to start developing your own trading strategies. I also want to say that even though today we use the moving averages, we use the envelope channel, we use the RSI and the MACD, these are indicators that I like, but you guys can use any indicators that you prefer. There are a million of them, and the best ones are the ones that you like best. So what's likely to happen is that you're going to take these indicators that I showed you today and you're going to get started with them. But you're going to do your research and you're going to find new indicators or new configurations that you're going to like better, and you're going to start using those. And that, guys, is fine, because that's the way things should be. You need to develop your own strategy. What I set out to do today was to tell you guys that there are different indicators that you can use that will make your life a lot easier. And I also wanted to show you guys what these types of indicators are and how they work with each other. But as far as what indicators you guys choose to use, that's up to you. That's your choice. And all things come to an end, so that marks the end of the mini course Tools of the Trade. In this course, we covered a number of things. We covered how to read charts, we covered how to find support and resistance levels, and we covered how to use indicators. Is this enough to make you a consistently profitable trader? Probably not. Probably not. Sadly, the real challenge in trading is psychological. The real challenge in trading is mastering your own emotions. However, what we did cover in this course is a great starting point. It's a great starting point to develop your career as a trader. It can teach you how to look at charts and whether or not you should be interested in a chart or not. And by doing this, you guys will be able to focus on the best plays, on the ones that have the highest odds of success, which is the technical aspect of your job. Your real day-to-day job is going to be controlling your emotions, having the right mindset, controlling your risk, and managing your capital. But what we covered in this course is going to give you a good, solid base to take care of the technical aspect of trading. And once again, guys, today is the last episode of Tools of the Trade, and I want to thank you. I want to thank you for checking out the channel, for checking out this mini course, for your support, and for being there. It honestly means a lot to me, and if you haven't done so already, I'd like to invite you to subscribe and like the channel and all of that. You know that stuff. But more than that, I honestly hope you learned something, and if you have any questions or any comments, please email them to me or post them on the comment section. I will be happy to answer them. Once again, guys, thank you so much for being there. I really appreciate it. And this doesn't mean that I'm not gonna post anymore. I'm gonna keep posting educational videos. I'm going to keep posting my trades, win or lose, and I'm gonna discuss my reasoning behind them. So feel free to check out more videos, see if you can learn something, okay? But as for Tools of the Trade, this is gonna be it. And once again, I want to thank you for being there. So guys, have a great day. It is December 27th today, so merry belated Christmas, and see you around, okay? Cheers, bye.